Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. And it has been a wild week, Luke, so let's get to it. The stock market volatility continues as inflation and the situation in Ukraine continues. That all just crowds the headlines. I want you to hear this clip from Bonafide Wealth President Douglas Boneparth. He tells Yahoo Finance that all of this really isn't that surprising.
It's been wild to see dramatic, if not historical, swings out of major economic and now geopolitical events taking place. It should be surprising, right? But we've seen crazier. That's the state of play right now for the markets. It's really a guessing game, and up is down and down is up half the time.
So, Luke Patrick, I mean, these quote-unquote experts that we hear audio from, they can't even tell what's going to happen next. So how are the rest of us, how are the retirees, the pre-retirees, how are we supposed to react to all this?
Well, you need a financial plan, and you need some advice and some experts on your side. You know, looking back over this event, you know, these events, we can say, oh my gosh, you know, we should have known this was coming. This was easy to predict. That's always looking back. So we have seen some crazier times, but it's getting pretty crazy right now. If you think about it, the 10-year Treasury has been moving between 5 to 8% per day. So your bond investments, your safe investments are either getting crushed on the downside one day or they're kind of rebounding the next day. But overall, interest rate sensitive investments are getting hurt quite a bit right now. And that's coming as the Fed's, you know, starting to raise interest rates.
Another way to look at all that with having your team and that financial plan is to lean on that plan and that advisor or team of advisors to remove the emotional side of the coin. We know just historically, if you were to look at the overall market, it has had an upward trend historically over the longevity of it. So you can think of it as a yo-yo on an escalator. It's going to go up in the long run, but we got to be careful of those ups and downs with the yo-yo on the escalator. So if you have that team there, you can help mitigate some of that emotional risk in there.
Do you run into that problem, especially because the headlines are so overwhelming, Patrick, that people come in, they call, they're just emotional. The sky is falling. Everything is just so rough right now.
Oh, for sure. We have clients that will call in on Doomsday Tuesday or something like that and try and talk them off the ledge. And if we would have executed something at 12:30 when they were questioning us about it and concerned about it, really there was a huge run back up at the end of the day that they would have missed out on. So we have to just be cautious and, of course, dot the T's and cross the I's on everything, but remove the emotional side as best we can.
Mm-hmm. Yeah, so historically, the stock market outperforms the average investor because the average investor makes the wrong decision, right? We get nervous when the market's going down, so we want out, and we feel good when the market's going up, so we want back in. Well, we have a rules-driven approach here at McPherson Financial Group. We have economic indicators. I said last week when you have a geopolitical event that as long as the event does not happen in a recession, the geopolitical part and, of course, the impact in that part of the world is bad. But from a U.S. stock perspective, as long as you're not in a recession, right, you're typically up 3 to 6 months after the event. And so right now, all of our indicators are positive from what we're seeing from the economy. So, you know, from that standpoint, it is kind of just a rocky, shaky period of time that, you know, hopefully, right, 6 to 12 months, we'll look back on this and say, okay, that was an event, but we're okay.
321-425-8550. Gas prices just continue to rise. You look back at summer of 2008, we had an all-time high of oil at $147.90 a barrel. And back then, Fed Chair Jerome Powell was aggressively cutting interest rates. But now we're reaching more highs. We're over $130 a barrel. But unfortunately, Luke, interest rates are going up. So what does that mean for us, for an investor, for a pre-retiree?
Well, for an investor, for a pre-retiree, if we're looking at this from an economic standpoint, when the price of oil goes up, it tends to slow down the economy. So historically, when the price of oil goes up, we tend to cut interest rates. Well, now it's the opposite, right? We still need to raise our interest rates, but because of everything happening in the world, because of oil, because of commodities, I mean, the price of wheat hit a limit up earlier this week. So there's a lot of things going on that are going to get a lot more expensive. That's going to slow the economy down in itself. And that, in my opinion, is going to, you know, have the Fed raise rates a little bit slower, right? Which is better for the stock market. So I think long term, this is going to play itself out from a standpoint of things will get more expensive. They'll get too expensive, and we'll stop buying it, or we'll stop using as much, and then they'll go back down. It's very cyclical, but I think the Fed's going to slow down the rising interest rate objectives.
Well, Luke, Patrick, let me ask you about an annuity. I mean, with all this inflation going on, is an annuity, could that be a good way to manage some of the risk and protect some of our savings and some of our income?
It is. So an annuity is a great way to take out some of the interest rate risk and some of the market rate risk. So if you use what we call a fixed indexed annuity, you get market participation on the upside of the stock market, but you get zero participation on the downside. There's not as much interest rate sensitivity there, whereas you'd have with a bond, right? When the interest rates go up, the price of the bond you own goes down. So it's a really good way to have a safer side of your portfolio, right? Annuities year to date, some of the ones we have haven't lost any money. So having that portion of your portfolio protected while still giving you some upside in an up market is very important.
And to add on that, we have to be, you touched on one of the words, X-rays. So that leads into annuity being a great tool to, like Luke said, hedge that risk, give you some upside potential, take that risk off the table. But you got to still be careful with fees. You got to make sure you're going to the right product, the right balance, not tying up too much money into a illiquid asset. So they can be a great play. Mm-hmm. This has to be a smart play to make sure it's just part of your equation.
And Patrick, when we talk about, we have someone take advantage of the complimentary portfolio X-ray, are they surprised at how much they're paying in fees?
Oh, yes. I mean, there was a contract I went through the other day that surface level, it looked like 1.1%. That's kind of average in the industry. Once you actually went into the details of the sub-accounts and everything else that's being feed on the account, it was 3.3%. So that shocked the client. And then you're paying that high fee. You are getting some of that risk mitigation from the market. But is it worth it? That's part of the balance we have to create in the X-rays that we do.
Yeah, and part of our fee structure here at McPherson Financial Group is we tell you what fees you're paying. If you're doing it on your own, or if you're in a 401k, or maybe you have another advisor, or however it works, there are fees coming out of your account even if you don't see them. And that's where we dive in and say, okay, here's what you're paying, here's what you see, here's what you don't see. And that's kind of the big shocking moment of, oh, wow, I didn't think I was paying any fee. Well, there's always a fee involved in something. And everything you do, there's a fee involved.
That number is 321-425-8550. Patrick, you mentioned off the air that there are some new opportunities within the McPherson Financial Group to really help us manage our risk.
Yeah, so that portfolio X-ray, we talked about already a little bit on the fee side, but the other side of the coin is the risk. A great example is, you've worked your life away, per se, right? You have all your money in your 401k, you have money set aside and other assets. Maybe you have another advisor you already work with. You can come and sit down with us and we can put everything into a portfolio X-ray that we do. And it actually spits out a back run of historical events with the funds you have, and it would give us our overall risk. So we can then put into one of our softwares and say, hey, if this full risk exposure was to happen tomorrow, what would happen to your assets? Could you still retire this year? If you're already retired, does it cut your assets in half? So that's one of the things that we can do, and what we do over here at McPherson to help mitigate that risk. We have to first expose it and find it first, and we will run a side-by-side comparison of where you're currently at, how you're currently invested, what those risks look like against our own models. And I've had examples where clients come in, they think they're secure, they've made great money the last 13 years in a big run-up we've had, but then once we look back before that, the risks that they're actually exposed to, I've seen upwards of 51% exposure. Our software doesn't go beyond 50%, so I have to actually max out our software to show what could happen tomorrow.
Mm-hmm. Yeah, it's funny. Our software, like Pat was saying, we can, map out all different kinds of scenarios, but one of them being, what happens if you have a big drawdown in the market? And what Pat was just relating to is we've had some clients come in that are now clients who had, drawdown risks of 50, 55. I've never seen a 60%, but essentially if you get over 50% in our software, we can't go any higher. We cannot tell the software you are going to lose more than 50%. So that's something to be very careful of when we look back to 2008 and 2009. Also something to think about is from 2000 to 2013 in the S&P 500, you didn't make any money. You went through the tech bubble, you got your money back, then you had the subprime mortgage crisis, and you came back to even in 2013. So you can't have all your eggs in one basket. Here at McPherson Financial Group, we use different types of assets that can't lose value in the markets, right? Different types of assets that aren't interest rate sensitive. Mm-hmm. We made changes to our portfolios in November and in December. We reduced risk 2 times, right? November and December, and we just reduced risk again 2 weeks ago. The first 2, November and December, was market rate risk. And then most recently, we reduced some interest rate risk by using a buffered ETF. So an exchange traded fund, essentially, right, high level on this fund, the investor takes on the first 5% down, but the -5 to -30 is covered, right? You do not lose any more money. So, and you still have an upside cap of 8 to 10% for the year. So these funds can work really, really well if you're worried about buying bonds and worried about interest rates.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.